Cost and Management Accounting. Part A. Discuss from a strategic perspective the continuing need for effective cost management and control systems within organisations. Any organisation needs to manage its costs in order to achieve its strategic objectives. A cost leader will seek to minimise costs so that they can reduce prices and compete effectively, and a differentiator will aim to manage costs so as to improve its margins. A not-for-profit organisation will aim to manage costs in order to make the best use of its resources. There are various techniques of overhead apportionment which are used to measure costs, including overhead absorption and activity-based costing. These allow assessment of the full cost of a product or service. Full cost is the total amount sacrificed to achieve a particular objective, including all related costs. Full costing supports decision-making in a number of areas, including pricing and output, how many should be made and what price charged to the customer, exercising control, by comparing actual and budgeted performance and addressing discrepancies, assessing efficiency. Current processes can be compared with different locations or alternative methods of working to determine the current efficiency. Assessing performance. Revenue generated by a product or service can be compared to its full cost. Strategic cost management means not just measuring costs and performance against budget, but focusing on what is driving costs, whether they can be reduced, and whether resources are being allocated in the best possible way to support the achievement of the organisation's strategy. Part B. Evaluate methods of forecasting, budgeting, standard costing and variance analysis in support of strategic planning and decision-making. Forecasting is a helpful technique which helps in planning and decision-making by making predictions about the future. They can be qualitative and based on judgment. Techniques for doing this include: the Delphi technique involves selecting a panel of experts, each of whom is asked to produce an independent forecast. These forecasts are shared, and each then goes on to produce a revised forecast. The process continues until they are in agreement and a definitive forecast is produced. Sales force opinions involve a sales manager gathering input from the sales team and collating their opinions into an aggregate forecast. Executive opinions arise from meetings of high-level managers during which they develop forecasts based on their knowledge of their own individual areas of responsibility. Market research involves the use of customer surveys to evaluate potential demand. Organisations can also use quantitative techniques which are based on the use of historical data to predict the future. They involve the identification of patterns and variations between variables, including linear regression and time series analysis. Linear regression measures the relationship between two variables. The strength of the relationship is measured by correlation coefficient, often shown as R, which can range from +1, exact positive relationship, through 0, no relationship, to -1, exact negative relationship. Time series analysis aims to separate seasonal and cyclical fluctuations from long-term underlying trends. It is therefore a form of regression analysis where one variable represents time. Budgeting is a business plan exercise for the short term, usually 1 year. It is likely to be expressed in financial terms, and its role is to convert the strategic plans into specific targets. It therefore fits into the strategic planning process. These budgets will then have to be controlled to ensure the planned events actually occur. This is as much a part of the budgeting process as actually setting the budget. Standard costing involves the establishment of predetermined estimates of the costs of products or services. the collection of actual costs and the comparison of the actual costs with the predetermined estimates. The predetermined costs are known as standard costs, and the difference between the standard and the actual cost is known as a variance. The process by which the total difference between standard and actual results is analysed is known as variance analysis. Variance analysis. When actual performance is compared to standards and budgeted amounts, there will inevitably be variances. They may be favourable or adverse, depending on whether they result in an increase to or a decrease from the budgeted profit figure. Variances may occur for a number of reasons. One possible reason is that the budget itself was not realistic. However, there are many other reasons why variances may arise, including poor staff performance, changes in market conditions, or process inefficiencies. Part C. Evaluate strategic options using marginal and relevant costing techniques. When an organisation is trying to decide between two or more possible courses of action, only costs that vary with the decision should be included in the decision analysis. Relevant costs are those costs that are relevant to a particular decision. All fixed costs are irrelevant to the decision because they will be the same whatever decision is made. Similarly, any costs which do not represent cash or have already been incurred are not considered relevant. As fixed costs are ignored, marginal cost, the cost of producing one additional unit, usually equals the variable cost per unit. This will be true unless there is a step in the fixed costs, in which case that step or increment will be included as well as the variable costs. Marginal analysis is particularly useful in 4 key areas of decision making. Marginal analysis can be used to decide whether or not a special contract should be accepted by determining the contribution, revenue less cost, that the price offered would yield. Positive contributions suggest the organisation would be better off accepting rather than rejecting the special contract. However, there will also be other factors that are difficult or impossible to quantify, which will also have to be considered before a final decision is made. Usually output is restricted by the level of demand rather than by the organisation's ability to produce. However, sometimes there is a limit to the amount that can be produced due to a scarce, limiting factor such as labour, space or machinery. The most profitable combination of products will occur when the contribution per unit of the scarce factor is maximised. A common decision faced by businesses is whether to produce the product or service they sell themselves, or whether to buy it from another business. Marginal costing can help with this by identifying the contribution of both options, as with accepting or rejecting contract decisions. However, there will be other factors that the organisation will have to take into account when making this decision. These other factors include loss of control of quality, potential unreliability of supply, and access to expertise and specialisation. Many organisations produce separate financial statements for each department or section in order to attempt to assess the relative effectiveness of each one. By using these to look at the variable costs, the contribution for each can be determined. This means the organisation can determine the contribution to the overall organisation that the individual departments make. Departments that make a positive contribution should not be closed even if individually they make a loss. This is because the fixed costs would still be incurred and the organisation would be worse off without it.